The last time the world saw a shift this big, most people completely missed it, and those who did not, they became millionaires right now. In 2026, something is happening that is going to define the next 20 years of wealth. Not next decade, the next 20. And I am not talking about one thing. I am talking about a collision, a pileup of economic forces that have never, ever happened at the same time in modern history. The stock market, gold, global trade, AI, the dollar, all of them moving in a way that textbooks do not even have a chapter for yet. And the scary part, most people are not paying attention. So that is what we are doing today. No fluff, just the facts and the data and exactly what it means for your money. So make sure to stay until the end, leave a like. And let us start. Here's the problem. Most people watch the news, see red numbers on their phone and feel sick, or they see green numbers and feel amazing. And that is it. That is the extent of their financial awareness. They react emotionally to headlines without ever zooming out enough to see what is actually going on. And I get it. The headlines are designed to terrify you or excite you. That is how they get clicks. But let me show you what is happening underneath all the noise, because what is underneath is way more important than any single headline. Let me ask you something. Do you know what happened on the 28th of January, 2026? The S&P 500 crossed 7,000 points for the first time in history. 7,000. This is an index that took nearly 3 full years to go from 4,000 to 5,000. Then it went from 5,000 to 6,000 in just 9 months. And then 6,000 to 7,000 in only 14 months. The speed of this is something we have genuinely never seen before. But here's what I want you to keep in mind as I walk you through everything today. This number 7,000 is not a celebration for everyone. In fact, for most people watching this right now, this number means absolutely nothing if you are not set up correctly. And being set up correctly is exactly what this video is about. Because right now we are not just in a bull market. We are in a moment of history, and the next 10 to 15 years will be shaped in large part by decisions being made right now in 2026. So, let me break this down, piece by piece. Let us start with the S&P 500 and why it is doing what it is doing. That milestone on the 28th of January was not random. It happened because of one thing above everything else: artificial intelligence. Not the hype version of AI you have been hearing about for the last few years, the real money-making, earnings-generating version of AI that is now changing what corporations are actually worth. Look at the data. Microsoft, before the 7,000 breakthrough happened, reported a $281 billion backlog in AI-related service contracts. Not future dreams, actual contracts, actual money locked in. Then Meta announced they are spending more than $115 billion in 2026 alone on AI infrastructure. The 4 biggest tech companies in the world, Alphabet, Amazon, Meta, and Microsoft, are collectively on track to spend $505 billion on AI infrastructure just this year. Now, think about what that means for a second. That is not money disappearing. That money flows somewhere. It flows into semiconductors, into data centers, into the companies building the actual physical machinery of AI. NVIDIA crossed the $5 trillion market cap in 2025. Broadcom, Micron, ASML, all of them seeing historic demand. This is a spending cycle unlike anything we have seen since the highway system was being built, except this time it is happening in years, not decades. And Goldman Sachs has already raised its year-end 2026 target, the S&P 500, to 7,600. JP Morgan has a bull case scenario of 8,000 if things play out right. These are not small numbers. But wait, here's the thing I need you to understand. The S&P 500 hitting 7,000 does not mean every part of the markets is healthy. It does not mean your money is safe just because the index is up. Because right now we have what analysts are calling a deeply split market. On one side, tech AI, semiconductors printing money. On the other side, healthcare companies getting crushed, consumer brands dealing with massive tariff headwinds, real estate firms struggling to refinance debt. Nike had over $1 billion headwind from tariffs. Procter & Gamble had to raise prices on 25% of its products because of a $1 billion annual tariff impact. United Health stock dropped nearly 20% in a single day. So the index is up, but the index is not the market. This is what makes 2026 so complicated and so important to understand. Now let us talk about tariffs, because this is where things get really interesting. The trade war has been the most significant shift in U.S. trade policy since 1993. Not since a few years ago, since 1993. Think about that. The Tax Foundation estimated that the tariffs amount to an average tax increase of $1,500 per U.S. household in 2026. Last year, it was $1,000. Now it is $1,500. That number is going up, and then on the 20th of February 2026, something major happened. The Supreme Court ruled 6-3 that the International Emergency Economic Powers Act, the legal foundation being used to impose sweeping tariffs on almost every trading partner, does not actually authorize tariffs. This immediately changed the landscape. The sweeping emergency tariffs fell. Only the specific sector tariffs, which cover areas like steel and aluminum, remained fully intact. Now, Does that mean the trade friction is over? The administration responded almost immediately with a 10% universal tariff using other legal tools, but the ruling removed the biggest and most aggressive pieces of the tariff structure. And then there is China. China hit back with 34% tariffs of their own export controls, measures designed to put real pressure on American businesses that depend on Chinese supply chains. The US-China trade tension is not going away, and pharmaceutical tariffs could hit 200% by mid to late 2026. Electronics remain in a gray zone. Here's what this means for you and for the economy. Companies like GM, Ford, Toyota, they have all started reshoring. They are moving production back to the US to avoid these costs. GM already paid $3.1 billion in tariffs in 2025. Toyota and Honda are both announcing plans to increase US-based manufacturing. This is a structural shift in how global supply chains are built that takes years to complete. And during those years, there is friction, there is cost, and there is uncertainty. The Federal Reserve, by the way, cut rates 3 times in late 2025, bringing the federal funds rate down to between 3.5% and 3.75%. And markets still expect more cuts in 2026. Lower rates reduce the cost of borrowing, which is fuel for business investment and growth, but at the same time, tariffs are pushing prices up. So on one hand, you have the Fed trying to support the economy, and on the other hand, you have trade policy making things more expensive. These two forces are pulling in opposite directions, and navigating that tension is genuinely one of the hardest challenges for any investor right now. Now, I want to get into something that I think is the most underappreciated part of the current economic picture, and that is gold. Because gold right now is doing something it has almost never done in history. Let me give you the numbers. Gold closed 2025 up roughly 60% in 1 year. The last time gold performed like that was in 1979, 1 year earlier, before 2025. It passed $3,000 an ounce for the first time ever, then $4,000. Then in early January 2026, it briefly touched above $5,600 an ounce. By April 2026, it is sitting around $4,750 to $4,850 an ounce, even after a pullback from that high. JP Morgan is forecasting gold averaging $5,055 per ounce by the final quarter of 2026, and longer-term forecasts put $6,000 as a real possibility. Now, why is this happening? Because there are multiple forces all pushing in the same direction at the same time. First, central banks are buying gold at a record pace. We are talking about over 700 tons purchased in the last 12 months by central banks, mainly emerging market countries, China, Turkey, India, Gulf states. They are quietly, steadily moving money out of U.S. Treasury holdings and into gold. The U.S. dollar share of global reserves fell from 71% in 1999 to around 56 to 57% by 2025. That is a huge shift. Countries are diversifying away from the dollar, and gold is where they are going. Second, the US dollar itself is weakening. A weaker dollar makes gold cheaper for foreign buyers. More demand, higher price. It is simple math. Third, the geopolitical conflicts in early 2026 have escalated. Crucial energy shipping lanes like the Strait of Hormuz have seen disruptions, threatening a route that carries roughly 20% of the world oil and natural gas. Oil prices spiked, inflation fears spiked. And gold, being the classic safe haven asset during global turmoil, went up fourth. Inflation is still real, not 9% like in 2022, but the CPI in March 2026 is still at 2.9%. It has not gone back to the Fed 2% target, and when people worry that their money is slowly losing value, they buy gold as protection. Now here's the part people miss. This is not just regular gold demand. This is structural demand. Central banks are not traders. They do not buy gold and then panic sell it 3 months later. They accumulate. And when 40 to 45% of central banks globally are planning to increase gold holdings, according to World Gold Council surveys, that creates a price floor that is not going to disappear anytime soon. The dollar share of global trade financing and global reserves is on a multi-decade decline. That is a slow-moving trend, but it is irreversible at this point. And gold is the main beneficiary. Here's something I want you to sit with for a moment, because I think this is the most important idea in this whole video. The stock market is not the economy. We hear this all the time, but do we actually understand what it means in 2026? Let me show you. The Magnificent Seven, Apple, Microsoft, Nvidia, Meta, Amazon, Alphabet, Tesla, now account for nearly 35% of the entire SP 500 market weight. That is a level of concentration we have not seen in decades. You could argue that the SP 500 is no longer really a picture of the American economy. It is basically a picture of 7 very powerful technology companies. Meanwhile, on Main Street, things look different. Consumer confidence is under pressure. Middle-income shoppers at major retail chains are buying smaller baskets. Nike earnings are struggling. Walmart is issuing cautious guidance about a murky consumer environment. Real GDP growth in the first quarter of 2026 is trending toward just 2%, a significant slowdown from the peaks of 2024 and 2025. So you have a stock market making new all-time highs and regular people feeling like things are tight. Both things are true at the same time. And this is not a contradiction. It is just what the economy looks like when the gains are concentrated in specific places. Now, why does this matter for you? Because if you are in the right part of the market, 2026 is one of the best periods in modern history to be building wealth. If you are in the wrong parts, traditional retail, old school software, highly leveraged real estate, you are getting crushed. The divide is real and it is widening. And this is where most people make the biggest mistake. They look at the market going up and they assume their money is fine. Or they look at the news about tariffs and conflict and they assume their money is in danger. Both reactions are lazy. The truth is much more specific than either of those conclusions. Okay, so here is the part of this video where I want you to stop and really focus, because everything I have told you so far, the AI spending supercycle, the tariff war, the gold surge, the disconnect between the stock market and the real economy, all of it points to one conclusion. And that conclusion is this: we are in the middle of the largest wealth redistribution event of the last 30 years. Not the largest crisis, not the end of the world, the largest redistribution. Meaning wealth is moving from one set of people and institutions to another, from those who are not paying attention to those who are, from those reacting emotionally to those acting strategically, from those in the wrong assets to those in the right ones. Let me give you the data to back that up between the 5th of November 2024, the day of the US election, and the 8th of April 2026. The SP 500 total return climbed more than 18%. Meanwhile, gold is up roughly $1,600 per ounce over the last 12 months. That is two completely different parts of the market both exploding at the same time. That almost never happens. Normally, when stocks are up big, gold is flat or down. When gold is up, it usually means stocks are scared. But right now, both are being driven by completely different forces and both are moving up. Now add to that the tax changes. The massive fiscal legislation went into effect on the 1st of January 2026. It made 100% bonus depreciation for business equipment permanent. It cut corporate and individual taxes. Estimates point to a net $127 billion boost to consumers. Federal tax refunds in early 2026 are tracking 13% higher than in 2025. The child tax credit expanded. Specific adjustments made tips and overtime tax-free. That money is going into the economy, into consumer spending, into savings, into investing. And the Federal Reserve cut rates 3 times in 2025. Lower rates, tax cuts, AI-driven productivity explosion, gold at historic highs, government held fiscal stimulus in the US and major European countries. Germany announced a $1 trillion package for defense and infrastructure, all of it happening at once. If you are in the right position for this moment, you are watching history make you richer. If you are not, if you are sitting in cash, if you are panic selling when things get volatile, if you do not have any exposure to the forces driving this market, then you are watching history make other people richer. And here's the thing that really bothers me when I talk to people. The biggest risk right now is not the global conflict. It is not tariffs. It is not even a potential recession. The biggest risk is inaction. Because the window to position yourself during a transition like this one is always narrower than people think. Go back and look at 2009. The SP 500 bottomed in March of that year. If you bought at the absolute worst point, the literal bottom of the financial crisis, you had 10 times returns over the next 10 years. But 95% of people did not buy in 2009. They were scared. They were waiting for things to feel safe, and by the time it felt safe, the opportunity was mostly gone. You know what the difference is between a 2009 buyer and a 2009 seller? It is not intelligence. It is not money. It is whether or not they understood that markets go up over time and that volatility is not the same thing as permanent loss. Peter Lynch, one of the greatest investors of all time, ran the Magellan Fund for 13 years and averaged 29% per year. Unbelievable track record. He had 7 drawdowns of 20% or more in those 13 years. 3 drawdowns of 30% or more. If you got scared and sold at any one of those moments, you would have locked in a loss and missed the entire 29% annual average that followed. Right now in April 2026, the market has already seen its dramatic swings. In April 2025, tariff announcements caused the SP 500 to crater nearly 20% in 7 weeks. Then a pause on those tariffs was announced, and stocks saw one of their biggest single-day rallies in history. The people who sold at the bottom of that 20% drop lost money. The people who held, or better yet, bought more, made serious returns. This is the pattern. This is always the pattern. It goes down. People panic. The people who do not panic buy more. It goes back up. The patient investors win. But here's what makes 2026 different from any other year. What makes right now a genuinely historic moment rather than just another market cycle? 1. The AI productivity revolution is real, and it is generating real earnings. Not just hype. Microsoft's $281 billion AI backlog is not speculative. It is booked revenue too. The global monetary system is actively shifting away from the dollar as the world's single reserve currency. That shift benefits gold, hard assets, and U.S. equities all at once.